Welcome to StokTok's deep dive into Stryker Corporation. Stryker is a leading manufacturer and distributor of medical devices, surgical instruments, and orthopedic implants, the tools and equipment hospitals and surgeons rely on every single day. At the time of recording, Stryker is trading at 327.96. Over the past 52 weeks, the stock has ranged from a high of 404.87 down to a low of 319.32. The Relative Strength Index, which measures momentum on a scale of 0 to 100, sits at 39.3, a neutral reading that suggests neither overbought nor oversold conditions. The 50-day moving average stands at 349.10, while the 200-day moving average is at 364.46. This places the stock slightly below its intermediate trend line, which warrants examination of the underlying fundamentals. Let's work through the analysis, scene by scene. Starting with a quick business overview. Stryker operates in a market where the barriers to entry are extraordinarily high. The company manufactures orthopedic implants, think hip and knee replacements, as well as surgical instruments, neurotechnology products, and patient safety equipment. These products command significant pricing power because surgeons and hospitals have invested in training, relationships, and integrated workflows around Stryker's platforms. The installed base and switching costs create a durable competitive moat. Revenue has grown at approximately 10.80% over the trailing 3 years and 10.90% over 5 years, demonstrating consistent demand in an aging demographic environment. Our StokTok score on this name is 50 out of 100, which we classify as a hold. Breaking that down, valuation rates 3 out of 20 stretched. Financial health scores 14 out of 20 solid, but with some leverage concerns. Profitability stands at 13 out of 20, respectable margins but not exceptional. Growth rates 12 out of 20, steady but not accelerating. And smart money positioning scores only 8 out of 20, notable caution among institutional holders. Now, valuation. The question every investor has to answer is, are you paying the right price? Stryker is trading at a trailing 12-month price to earnings ratio of 40.87. That is expensive relative to the broader market multiple, which typically ranges between 18 to 22 for mature industrial and healthcare equipment manufacturers. The forward price to earnings ratio, which uses next year's expected earnings, comes in at 22.94, which suggests the market is pricing in some earnings growth acceleration. The PEG ratio, which divides the P to E by the expected growth rate to reveal whether growth is fairly valued, stands at 1.79. A PEG above 1 typically signals that a stock is trading at a premium to its growth rate. The enterprise value to EBITDA multiple, which compares the company's total enterprise value to earnings before interest, taxes, depreciation, and amortization, sits at 22.69. Again, elevated relative to historical medical device averages, which typically range from 14 to 18. The price-to-sales ratio of 5.28 is also on the rich side. From a competitive moat perspective, the data suggests Stryker possesses durable pricing power through its installed base of surgical systems and trained physicians, plus switching costs that protect market share. But the market is pricing in near perfection. GuruFocus Value, an algorithmic intrinsic value estimate, is 309.88 at the time of recording, compared to the current price of 327.96. This implies a margin of safety, or discount to estimated fair value, of 16.24%. Wall Street analysts at the time of recording have a consensus mean price target of 419. The range is wide, from a low target of 316 to a high of 469, with 27 analysts publishing coverage. This broad consensus by rating reflects optimism about long-term secular demand for orthopedic and surgical devices in aging populations. The next earnings report is due April 30th, 2026, with the street expecting earnings per share of approximately 2.98. Market sentiment around Stryker. As of the creation of this video, Leans bearish. Broader market concerns about supply chain constraints and operational cost pressures in the medical device sector are creating headwinds. Valuation here is stretched relative to the company's historical trading multiples, in our view, while the GuruFocus Value suggests modest downside protection. An investor paying the current price is betting on sustained double-digit earnings growth. Moving to financial strength, how solid is the foundation? The Piotroski F-score, which is a 9-point quantitative checklist of financial health signals examining profitability, leverage, liquidity, and operating efficiency, comes in at 6 out of 9. A score above 7 is generally considered healthy, so Stryker is just slightly below that threshold. This warrants closer inspection of the component metrics. The Altman Z score, which is an academic model that estimates bankruptcy risk using a combination of profitability, liquidity, leverage, and solvency ratios, scores 4.71. This is comfortably in the safe zone. Z-scores above 3.0 indicate low bankruptcy risk. On the balance sheet, the cash-to-debt ratio stands at 0.26. This means for every dollar of debt, Stryker holds approximately 26 cents in cash. That is moderately leveraged, which is not uncommon for mature medical device manufacturers with stable cash flows. The debt-to-equity ratio is 0.71, indicating that the company carries 71 cents of debt for every dollar of shareholder equity. That level of leverage is manageable for a company with Stryker's stable revenues and market position, but it does constrain financial flexibility during downturns. The current ratio, which divides current assets by current liabilities and measures short-term liquidity, is 1.89. This suggests the company can cover short-term obligations nearly twice over, which is healthy. Interest coverage, the ratio of operating income to interest expense, was not available in the data provided. Overall, the balance sheet is solid but moderately leveraged. The company has sufficient liquidity to fund operations and capital investments, but limited dry powder for major acquisitions or share buybacks without tapping debt markets. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, which measures how effectively the company deploys shareholder capital to generate returns, stands at 9.58%. For context, that is modestly above the weighted average cost of capital for a medical device company, which typically ranges from 7 to 9%. This indicates the business is creating shareholder value, but not at an exceptional rate. The gross margin, the percentage of revenue remaining after direct costs of goods sold, is 63.96%. That is excellent and reflects the pricing power and manufacturing efficiency Stryker enjoys in its core orthopedic and surgical device markets. The operating margin, which measures profitability from operations before interest and taxes, is 20.14%. This is solid for a diversified medical device manufacturer and suggests disciplined cost management. The net margin, which represents profit after all expenses and taxes, is 12.92%. That is respectable, but indicates that taxes, interest expense, and other below-the-line items consume a meaningful portion of operating earnings. The free cash flow margin, the percentage of revenue that converts to free cash flow available to equity holders, is 17.5%. This is excellent and significantly exceeds the net margin, which often signals that the company converts earnings into cash efficiently and may benefit from favorable working capital dynamics or lower actual tax rates than the statutory rate. Taken together, the profitability metrics paint a picture of a business with pricing power and efficient operations, but not at the top decile of the healthcare sector. The 16.25% free cash flow margin is a point of strength and suggests that the company can fund dividends and debt service comfortably. On to growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years has averaged 10.80%, while 5-year revenue growth stands at 10.90%. This consistency is noteworthy. Stryker has sustained double-digit top-line expansion in both periods. However, The similarity between the 3-year and 5-year rates suggests there is no acceleration and potentially hints at some deceleration relative to prior years. For a company with Stryker's market position and the secular tailwind of aging populations in developed markets, maintaining low double-digit growth is respectable, but investors expecting acceleration may be disappointed. Book value growth over 3 years came in at 10.10%, which is in line with earnings growth. This indicates the company is not destroying shareholder equity and is retaining earnings responsibly. The dividend yield is 1%, which is modest. Stryker pays a dividend, but the payout is conservative relative to free cash flow, leaving room for capital allocation through buybacks or debt reduction. The growth profile here is steady and predictable rather than exciting. The company is benefiting from secular demographic trends, aging populations requiring more orthopedic procedures and surgical interventions. But organic revenue growth is not accelerating, which may partially explain why the market has valued the stock at a premium multiple. If revenue growth were to inflect upward from current 10% to high teens, the valuation would look more reasonable. At present levels, the growth rate does not fully justify the P to E multiple. Now let's talk smart money. What institutional capital is actually doing with this name? 14 top-tier gurus and super investors currently hold Stryker, indicating some institutional conviction. However, the composition of that ownership reveals caution. Among the largest holders, Terry Smith of Fundsmith, one of the most respected value investors in the world, holds Stryker at 7.57% of his portfolio, but has reduced the position by 19.68%. Jensen Investment Management, which manages significant institutional assets, holds the stock at 4.05% of portfolio, but has reduced by 40.04%. Mayors and Power Funds holds a minimal 0.01% of portfolio, while reducing by 5.34%. This pattern of outflows among top holders is a red flag. These are sophisticated investors with proven track records, and they are voting with their feet by trimming exposure. Among institutional filers on 13F forms, the SEC filings where professional money managers disclose holdings, only 12% are net buyers, meaning the majority are either maintaining positions or reducing them. This is decidedly not bullish. Insider ownership is very low at 1.55%, which signals that management has limited financial skin in the game. Over the past 3 months, there have been 0 insider buys and 2 insider sells, which again suggests management does not view the stock as attractively valued. When you combine tepid guru positioning, majority institutional outflows, minimal insider ownership, and recent insider selling, the smart money picture is one of institutional skepticism relative to the current price. The market may be pricing in optimistic scenarios that sophisticated capital has already discounted. And finally, the verdict. Let's bring it all together. On valuation, Stryker is trading at a premium multiple with a 40.87 P to E, elevated EV to EBITDA, and a forward price to earnings that implies meaningful earnings growth. The GuruFocus Value does offer some downside protection, but the current price is not a screaming bargain. Our view is that valuation is stretched. On financial strength, the balance sheet is solid with an Altman Z score in the safe zone and manageable leverage at 0.71 debt to equity, but the Piotroski F score of 6 out of 9 is slightly below our preferred threshold, and rising interest rates could pressure debt service. Financial health is adequate but not exceptional. On profitability, the company delivers strong margins with a 63.96% gross margin and 17.05% free cash flow margin. Return on invested capital of 9.58% is respectable. Profitability is genuine and provides cash generation, though not at the top tier of the sector. On growth, 10.80% 3-year revenue growth is solid and reflects demographic tailwinds, but 5-year growth is nearly identical, suggesting no acceleration. For a company trading at 40 times earnings, this growth rate appears insufficient to justify the multiple. On smart money, Top-tier gurus are reducing positions. Institutional ownership shows only 12% net buyers, and insiders are selling. This is the most concerning signal. The sophisticated capital that moves markets is skeptical. Our overall thesis, based on publicly available data, is that Stryker represents a hold. The company is operationally sound, profitable, and benefits from durable competitive advantages and secular demand drivers. However, the valuation has decoupled from growth, and smart money positioning suggests caution. An investor considering Stryker at these levels might wait for a more attractive entry point, perhaps closer to the GuruFocus Value or a 10% pullback, before initiating a position. For existing holders, the case for trimming exposure aligns with what the smart money is doing. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Stryker Corporation. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.